Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us here at AusBiz. Well, it was a choppy session on global markets overnight. Equities initially supported on Wall Street with the release of weaker than expected US inflation data. However, stocks oscillated between gains and losses throughout the day. And US quarterly earnings, they get underway tonight with the results of the big banks, which are expected to post stronger profits fueled by deal making and trading. Goldman Sachs will be one of the first. Its shares gaining ahead of its release of earnings. Elsewhere, healthcare was among the worst performing sectors on the S&P, with Eli Lilly falling after it forecast fourth quarter sales of weight loss drug was a pound below estimates. Boeing fell after the aircraft maker's annual deliveries dropped in 2024 to their lowest level since the pandemic. Shares of gold miners rose as the bullion price extended its gains, and US listed shares of BHP and Rio rose, reflecting gains in copper and iron ore. Well, US Treasury yields have eased after data showed producer prices increased modestly in December in the States. The producer price index rose 0.2%, while the annual rate accelerated 3.3%. The ex-food and energy core measure remained at 3.5% year on year. With attention now turning to consumer price index for December, which is due out tonight and forecast to come in at an annual rate of 2.9%. Well, the US 10-year yield was down 1.7 basis points to around 4.78%, and the 2-year falling to 4.36%. While disinflation is continuing, the risk is that the pace will slow this year, which has led Bank of America Securities to declare that the Fed's easing cycle is over. Goldman Sachs expects just 2 cuts this year in June and December, revised down from 3 previously. The US dollar has weakened a little in response to reports that the Trump administration may take a measured approach to tariffs and apply them gradually. The Aussie dollar is up to 62 US cents. Meanwhile, Bitcoin has gained to be around 96,500 US dollars. Oil prices have slipped after a US government agency forecast steady US oil demand for this year while lifting its forecast for supply. Brent futures falling around 1.3% at close to $80 a barrel. Copper up 0.4%, iron ore up more than 1.5% to $101 US dollars a tonne, and gold up around 1/3% to $2,671 an ounce. Well, let's take a focus now on the Indian markets, and Mugunthan Siva joining us again from India Avenue Investment Management. Mugunthan, good to see you.
Likewise, Andrew. Happy New Year.
Happy New Year to you. Is it a Happy New Year on the Indian market? I've noticed that the Nifty has come off somewhat. What are your observations and why is that the case?
Well, from a high in mid-September, let's say it's down about 12%, which is a significant fall. As you can see on the chart there, the fall has pretty much accelerated in the last few weeks. So this has been driven by the fact that earnings are off the pace of what they were since COVID. We saw, the acceleration of earnings at about 20% per annum over the first 4 years. That's now in the September quarter results. We were looking more flat, and this half will be just slightly positive. So we are seeing a little bit of a cyclical soft spot, as we discussed last time, I think. And we think structurally everything will be fine, but valuations have been high, and that's being pared back a little bit for the favour of the US markets, which seems to be everyone's darling.
Well, yeah, that's certainly affecting the Australian market too, isn't it? But so you talk about those lofty valuations, I guess, we've seen in India. So you're saying investors now looking for that earnings certainty?
Correct, yeah. There's been a switch from playing the valuation game post-COVID, when India was available at attractive valuations. That catch-up has occurred really over the last 4 years. In the last couple of years, supported more by robust earnings growth. But what we're seeing today is as that earnings slows, the market, getting narrower in terms of the companies that have that locked in or safer, sustainable earnings growth being rewarded, whereas the others are getting hit when they don't report quite the same numbers as what they have in the past.
So as a result, what's your strategy at India Avenue?
So yeah, it's very much, we played the valuation space from post-COVID, and now really over the last year we've been transitioning towards quality earnings, sustainable earnings, greater look-through and clarity and transparency in what we can expect going forward, which is in less companies. So increasing the conviction of companies and focusing on, clarity of earnings growth.
All right. Nonetheless, any particular sectors or companies that you are focused on at the moment?
Yeah, this might sound a bit boring, and it's really tech and pharma which continue to meet the eye. In a cyclical slowdown, you'll probably find more domestic cyclical industries get impacted, but tech and pharma tend to generate most of their revenue from offshore. In India's information technology industry, over 90% of revenue comes from the US and Europe. And in pharmaceuticals, more than half of the revenue comes from offshore. So those industries we feel probably have greater diversity. There's some structural, tailwinds. We've discussed about pharma with a big patent cliff coming up, means that a lot of the Indian firms will participate and win market share in that space.
Now, it would appear globally, investors really not wanting to take solid positions, particularly ahead of Donald Trump's inauguration, which is only a few days away now, of course. The focus very much still on tariffs and trade. What are you watching for, particularly with the likely impact on India?
Well, I think in the Trump administration and regime as such, they are going to look at targets where probably there's a high level of export-import trade. So economies like China, Canada, Mexico, probably first in the firing line when it comes to tariffs. India's trade with the US is still only around US 75 billion. So it's still relatively small. We expect some ramifications, but we think the impact on the Indian economy at this stage, given the trade relationship, is not significant. Interestingly, the trade between India and China has been rising.
And would you expect that to continue? It's interesting what these sort of blocks that are likely to develop. It's impossible to second guess Donald Trump. You may even anticipate that he doesn't know himself what he's going to do next. But does it potentially throw up more opportunity for India, particularly to forge some new partnerships?
I think so, because I don't think the US would want to make enemies of every economy or every potential global power going forward. And I think India certainly has certain comparative advantages that the US can utilize. We discussed previously about US healthcare costs rising and the inflationary impact there. So in a way, India winning market share and being able to produce generic medicines at a far lower cost than anyone else can be positive for the US and in terms of controlling their inflation. So they will take a focus on certain economies where there's probably more of a strategic difference in thought, but I don't know if India will be one of those. I think the US has shown its hand previously in saying there's certain aspects of India's, particularly in the employment space, where they can utilize that for their benefit.
Let's cast out a little further to the end of the decade. Now, forecast that India is likely to surpass both Germany and Japan in terms of its size of the economy. Does that look to be on track as far as you're concerned? What are some potential risks perhaps for the Indian economy?
Yeah, so the risks are always going to be driven by higher inflation. Anything that I suppose slaps the handbrake on India's growth story, which generally will be mismanagement of the economy, a very weak rupee, high inflation. Inflation is driven by food and energy prices. So there's a lot of discussion about where oil prices are going. An outlier could be oil prices accelerate because of shrinking supply, and that could be negative for India. Food prices are seasonal. It's very hard to interpret where they could go. So those are the risks. But I think the underlying is 1 out of 4 people who is employed in the world is going to come from India. So the age bracket of 15 to 65 is heavily represented by Indians, and that has to mean an increase in GDP per capita, which should lead to greater spending and greater wins globally. So I have no doubt they'll get to 3rd spot by the end of the decade.
Mugunthan, great to catch up with you. Thanks for joining us in New Avenue Investment Management.
Thanks, Andrew.
Let's come back locally ahead of the Open here. We are expecting a mildly positive beginning with SPI futures up 6 points. Stay with us because the Open is just a couple of minutes away.